faithfully delivering value, exploring great books worldwide. Hi, this is Sally with Book Insights. Today, we're diving into a book called Financial Psychology. The author, Laszlo Veg, is a successful investment banker, fund manager, and derivatives investor. He also wrote the bestseller, The Inevitable Economic Cycle. To put it bluntly, Laszlo Veg is a master at exploiting novice investors. Meanwhile, he writes books advising new investors on avoiding risks and self-protection. It's akin to a gambling expert teaching players how to win against him. So it's no wonder that this book has been reprinted over 50 times and is a global bestseller. So, the book Financial Psychology highlights a crucial insight. Market prices are directly influenced by the psychology and cognition of those involved. I'll break it down for you into three parts. The key takeaways. First, the four fundamental principles of financial markets. Second, what information is most valuable in financial markets? Third, how investor psychology drives stock market rises and falls. Starting with the first part on the four fundamental principles, I'll begin with the historic Wall Street crash. In 1929, the U.S. stock market was in a 10-year bull market. Back then, everyone in the market thought stocks were a sure way to profit. But on October 24th, the stock market suddenly plummeted. In just 2 weeks, $30 billion in wealth vanished. That was equivalent to the total cost of World War I. The crash didn't bottom out until July 8th, 1932. In those 3 years, U.S. GDP halved, 110,000 businesses went bankrupt, over 8,000 banks failed, and 17 million people lost their jobs. Even Irving Fisher, an economics professor at Yale University, wasn't spared. He was once the richest economist globally, hailed as the Wall Street prophet of the 1920s. But in that crash, his $15 million fortune vanished. In 1935, Fisher was forced to retire from Yale, and when he died, he still owed money to friends and family. $75,000. Besides Fisher, John Maynard Keynes, the most renowned economist of the 20th century, also nearly went bankrupt in that crisis. Hearing this, you might think, why did the world's top economists lose so badly? And after the 1929 crash, financial crises kept popping up, each bringing similar tragedies. Have people learned nothing? I'm afraid there are mysterious forces in the capital market beyond financial theories. The financial psychology summarizes four fundamental principles of these mysterious forces. First principle, markets lead the economy. This means the stock market acts as an economic barometer, anticipating trends. Generally, during recessions, stocks fall before economic indicators. During recoveries, stocks rise ahead of economic improvements. Why can markets anticipate economic trends? Because frontline investors develop expectations about upcoming changes. If investors notice declining orders and demand at industry leaders, they'll sell that company's stock. They may recognize risks even before the company's management does. Conversely, overflowing orders and strong demand lead them to buy. This market insight enables rapid stock reactions. So how far ahead does this economic leading indicator actually lead? Bruno Solmick, first president of the European Financial Association, found stock reversals lead economic reversals by 6 to 9 months. Only after 6 to 9 months of rising stocks do corporate sales and financial metrics reflect improvement. Of course, real markets involve human manipulation and intervention. As Laszlo Veg notes, markets aren't always right. The barometer has flaws due to irrationality. Now, for the second principle. Markets are irrational. 17th century Holland was capitalism's most advanced nation. Dutch elites saw tulips as status symbols, driving prices ever higher among the upper class. At the peak, one tulip bulb equaled the value of a brewery. Foreign investors joined the frenzy, buying heavily on minor dips. Eventually, people questioned, how could bulbs be so valuable? Panic and collapse followed. A cruel outcome. Once priceless bulbs became worthless, devastating countless investors. Tulip bubble plunged the Netherlands into a prolonged economic depression. Since then, the Netherlands fell from its position as the world's leading empire, and Europe's center of prosperity shifted to England. This is the famous tulip bubble in history. What does this story illustrate? That the market is composed of millions of people. Under group influence, people greedily buy and fearfully sell. The market, controlled by collective delusions, becomes hysterical. This collective irrationality also demonstrates the third principle. Predicting long-term economic trends is impossible. Why? Because of the butterfly effect. A small, insignificant action can trigger massive chain reactions. There's a saying in finance, an old lady in Brussels selling a few bonds could crash the Japanese market. In other words, market developments are entirely unpredictable. Any minor change could lead to vastly different outcomes. And when stocks rise, everyone piles in. But when stocks fall, people trample each other. Human nature amplifies small gains, losses, or even rumors beyond proportion. You might predict a market decline, but timing and extent remain elusive. Since economies are swayed by minute details, long-term forecasting is futile. Peter Lynch, one of history's greatest investors, also said, "Never attempt to predict markets 1 or 2 years out. It's simply impossible." If financial markets are unpredictable, what value do economists and analysts offer? Despite unpredictability, their research aligns market expectations and nudges them closer to economic reality. In fact, they're often wrong. To counter irrationality, traders use technical charts seeking patterns, but these too reflect collective psychology. This is the fourth principle. Technical patterns are self-fulfilling. What does this mean? It means technical patterns emerge from trading behaviors themselves. For example, imagine a market with 1,000 powerful investors, 900 technical traders versus 100 value investors. Based on stock fundamentals, all traders are bullish. Everyone buys in, pushing the market steadily higher until a certain price point. Say at a previous high, all 900 technical investors decide to sell, while the remaining 100 value investors hold back. Finally, 900 sell orders hit simultaneously, causing prices to plummet. After some time, the market reverses and prices rise again. Thus, remembering the last crash, those 100 value investors decide to exit at the previous high. Suddenly, all 1,000 investors act as technical traders, selling at the same point. This is technical patterns becoming self-fulfilling. Think about it. With limited technical tools, most traders use identical methods and take identical actions, collectively driving pattern fulfillment. All right, that covers all four fundamental principles. Investing is highly complex work. Professional investors outperform most participants. Why? Beyond knowledge gaps, amateurs lack critical information access. Valuable insights enable sound decisions. Now for part two, what information holds real value in financial markets? According to Laszlo Veg, market information falls into two types: news reports and actual trading data. Veg believes news reports hold zero value. He demonstrates how market moves often contradict news narratives. Example, when Business Week's cover predicted falling bond prices, bonds actually surged. Another cover proclaimed stocks, the investment choice, then stocks fell, posting record losses within 3 months. Why do news and market movements contradict each other? First, people assume media information must be truthful. Yet publicly available news often contains ambiguity, contradictions, or outright falsehoods. Prussian military theorist Clausewitz said that most unfiltered information is wrong and thus can't truly reflect market trends. Secondly, the value of news messages is greatly diminished the moment they're released. As we mentioned earlier, markets lead the economy. Before official good or bad news hits, market prices have already reflected people's expectations. So when news is formally announced, prices are often already at their peak or have bottomed out. Thirdly, A flood of complex news info puts huge pressure on nerves, causing doubt about sure things and leading to wrong judgments. In reality, the direct factors affecting financial prices are people's judgments and perceptions in the market, and the media can't predict group cognition. Therefore, in Laszlo Veg's view, news info has little value for investors and is misleading. Relying on financial news won't make you money in stocks. So, if you want to earn money, you should focus on the trading info of market participants. Participants fall into two types: market big shots and retail investors. Retail folks are the least savvy, while big shots generally earn more. Firmly following them helps us profit. Laszlo Veg says market big shots come in three kinds. First, executives holding over 5% of a listed company's shares. Second, big capital holders on stock exchanges. Third, financial arbitrageurs. Currently, these key market operators must file their trades with regulators and make them public so you can spot their traces in open info. First, if listed company executives sell large amounts of stock, it might be for cash to improve life, but more likely they know the company's in trouble. Moreover, this is a dangerous sign. Conversely, if execs buy lots of company stock, they think it's undervalued or the firm will grow well. Because execs know the company best, Laszlo Veg says tracking insider execs' trades is more effective than reading 1,000 profit forecasts. Now, capital big players, often called main funds, refer to Social Security funds, insurers, public funds, brokerages, QFIEs, etc. They're state-owned or large commercial bodies, and their moves sway market ups, down, and sector rotations. If data shows they're selling heavily, it signals an impending market decline. Conversely, if their selling volume is minimal compared to total market sales, the market likely won't fall. Lastly, financial arbitrageurs. They spot price shifts earliest, using trades to hedge risks. Tracking them anticipates price movements. Mike and arbitrageurs detect changes first because many work directly in industries like iron ore, crude oil, or coking coal. When they detect raw material price drops, they immediately sell futures to prevent company losses. So if arbitrageurs sell, prices will likely fall. It covers the three big players, but even professionals stumble sometimes. Why? Because while information is crucial, mindset determines everything. Now to part 3, how investor psychology fuels stock market swings. Psychology represents hidden needs and desires we may not recognize, yet it profoundly affects our actions. Laszlo Veg notes that both professionals and retail traders are vulnerable to 4 psychological traps. First, regret. When stocks surge without you, intense regret emerges, making you want to kick yourself. At the slightest dip, you rush in to correct your mistake. Classic regret-driven behavior. Second, overconfidence, subconsciously crediting success to skill rather than luck. After winning, investors become cocky, believing they've mastered trading, leading to reckless, frequent trades. In investing, frequent traders rarely achieve stable returns. Third, conformity, going with the flow. People easily yield to majority opinions, aligning actions with the crowd. I buy when others buy, at whatever price they're buying. The fourth mindset is self-defense. When outcomes contradict expectations, people won't admit mistakes, but instead ignore or twist uncomfortable information, seeking comforting facts. For example, when facing big stock losses, we avoid checking portfolios or seeing exactly how much we've lost. We ignore bearish news and avoid trading. Bullish news makes us sit up, listen intently, and even start trading. That covers all 4 mindsets. To Laszlo Veg, market rises and falls stem directly from these 4 psychological forces. Consider an uptrend. Early on, uncertainty keeps many out while pioneers gradually push prices up. Then regret hits latecomers who desperately await dips to follow big players. At minor pullbacks, they rush in en masse, further boosting prices and attracting analyst attention. Amid analyst hype, more investors pile in, prices surge, and early gains fuel overconfidence about easy money. Driven by arrogance, they keep investing, convinced they'll earn more. Continuous buying lifts prices further, making capital raising easier for listed companies. This funds real economy investments, boosting growth, which in turn sustains the rally until sell signals vanish. Everyone hears only bullish voices, maintaining uniform buying, proving uptrends are psychologically driven. So, when does an uptrend end? Laszlo Veg offers two simple gauges. First, watch previous congestion zones, price ranges where stocks traded heavily for extended periods. As long as prices stay above these zones, the trend remains intact. Sell when prices fall below previous congestion zones. Second method, watch price charts. An uptrend continues as long as prior peaks consistently become new support levels. Conversely, when prices stop making higher highs and higher lows, a reversal is coming. Now let's examine downtrends. In bullish fervor, everyone goes all in buying at full capacity. But when stocks fall, especially causing full position losses, immense psychological pressure builds. Attitudes can shift in hours, minutes, even seconds under such strain. People start seeing prices as overvalued and expecting continued declines, triggering new selling pressure. Amid sustained drops, herd panic emerges from observing others' actions, fueling further declines. At this stage, only bearish voices dominate, drowning out all others. If bull markets thrive on regret over missed gains, bear markets feed on loss aversion. So with stocks this battered, have they bottomed? Will the downtrend continue? How can we judge? Laszlo Veg notes, in charts, as long as peaks keep breaking below prior bottoms, the downtrend persists. Earlier, we covered identifying uptrends and downtrends. Actually, beyond price charts, trading volume is crucial for trend analysis. Despite market noise, trading volume never lies. Bull markets typically have higher volume than bears, reflecting different attitudes toward gains versus losses. In bulls, profits boost confidence and frequent trading, significantly amplifying volume. In bears, losses trigger defensive holding, betting on rebounds, leading to low volume. So how to practically use volume for trading decisions? Laszlo Veg outlines two methods. First, stocks opening with high volume at prices differing from yesterday's close tend to revert toward that close. This large opening volume usually results from overnight news, which gets fully priced in at the open. Subsequent price action then tends to revert toward the prior day's closing price. Second method, generally higher volume strengthens support levels. Price floors where declines stall, meaning when a stock surges on heavy volume, previous highs often become current support that rarely breaks. Buying at support levels is relatively safe, with minimal risk of getting trapped. Though some technical indicators can aid judgment, but Laszlo Veg stresses that markets remain governed by human cognition and emotion. That concludes our coverage of financial psychology's core content. Let's briefly recap. First, we explored financial markets' four fundamental principles. Second, the three most valuable information types. Finally, we examined the psychological engines driving market uptrends and downtrends. People always believe they've learned from financial crises, yet they repeatedly walk into new crises rooted in unchanging human nature. Veg concludes, listen to what the market says, not what investors claim. All right, that completes our interpretation of financial psychology. Reading notes are below the audio. See you tomorrow.